Williams Percent R indicator. You can make a lot of money with this if you do it right, and you'll lose a lot of money if you use it wrong. So obviously today we're going to teach you the right way to use it. The counterintuitive thing is that the way it's normally taught is 180 degrees wrong. It's exactly the opposite of what you should be doing. The way the indicator is normally taught, the losing way, the traditional way, is to look for overbought and oversold levels. And those are defined, you can see them plotted here, at 20, it's actually negative 20 and negative 80. That's one of the things that confuse some people about this particular indicator. It uses negative numbers. It has a range of negative 100 to 0. Now, it is a bounded indicator, and we're going to come back to that for a moment, but just kind of put that feather in your cap there, and you remember that it is a bounded indicator. It can only go from negative 100 up to 0, and that's it. It is mathematically bounded. So when it comes up, and here is what they traditionally teach you, is they say, alrighty there, Skippy, when the indicator gets below 80 and goes back above 80, then it is oversold. This is oversold. And so if it's oversold, then we should buy. And it kind of looks good there, right? And this is where you can get faked out with this thing, is because you can actually find examples, isolated examples, where that technique will look good. People like those terms, overbought and oversold. You should run away from those terms, overbought and oversold. There is no such thing in the markets as overbought or oversold. Eliminate those terms from your trading vocabulary. They will cause you to lose money. Professional traders, we don't use those terms. The opposite, they will say this, all right, amateur trader, what we're going to look for is the market to get overbought. Okay, gets above 20, and then we're going to sell that puppy dog, and down she goes, and down she goes, and down she goes. So when it's overbought, we sell. When it's oversold, we buy. Okay, and that's great if you want to buy your broker yachts and mansions and Ferraris and Lambos. So I like my broker, but as far as I'm concerned, they can buy their own yachts, Ferraris, what do they say, Lambos, whatever. Okay, so nothing against them. I don't even want the yachts and the Lambos for myself, but I do want to make money for myself to support my kids, my family, my charities, etc. I'm sure like you. So how do we make money for ourselves instead of giving it to the person on the other side of our trade, whoever it might be? We're going to do the opposite. Most of trading, here's a little tip for you, by the way, you should make note of. This is a general principle that applies to all of trading and almost all of technical analysis. Trading is opposite world. The things that you've been taught, classic technical analysis, does not work anymore. And a lot of the reason for that is that, well, things have changed. Technology has changed, etc. And the other thing is that everybody knows it. So when everybody in their gerbil knows something in technical analysis, then it stops working. You don't have an edge anymore. Everybody in their parakeet's doing it, and the masses are always going to be wrong in the markets. That's the way it works. Maybe I'll do another video on why that actually has to be the case. Several signals before this. See, that's where like textbooks will say, oh, this is where you buy. And that's why we call them textbook examples. So they're perfect. But the market's not perfect. It's noisy. And so we had that signal back here, and that didn't go anywhere. We had that signal here, and that didn't go anywhere. So there's several false signals, 2 false signals before the final third one. So do you want 2 losses before finally a winner? No, obviously not. Therefore, what are we going to do? We're going to do the opposite of what everyone else is doing. We're going to wait and do the thing that doesn't seem to make sense. We're actually going to wait for the indicator to get what everybody else is calling overbought. But again, remember, it's not really overbought. That's a misnomer. And so when it gets up here above 20, that's when we're looking to get in, because what this is really mathematically measuring is strength in price action. And so what we have here is strong bullish price action, and that's what we want to buy. Strong bullish price action. And then we're just going to stay into that as long as it remains strong. So as we go forward, again, look, keeps going, keeps going, keeps going, keeps going. Okay. And so here, as you could see now, this entire time, it remains so-called overbought. Again, don't use that term. I'm using that term just to illustrate why that term is bull cookie. And with that bull cookie term, the market remains bullish, 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 bullish. So it's not oversold, or it's not overbought. And one of the reasons that it's not overbought mathematically is what I mentioned earlier, and I told you to put a pin on that, put a feather in your hat, remember it. It's because the indicators are bounded. Mathematically, it's only allowed to go up to 100 or up to 0. And it's not mathematically allowed to go any higher. So why doesn't it go above 100? Well, simply because it's in the math. It's in the equation. It's in the formula that it can't go higher. So when it gets up here, that's actually a sign of strength, bullish strength in this case, and not overbought. And that's why we want to buy it. We want to buy bullish strength. That makes sense? This is called logic. All right. But the problem is most people don't understand the indicators that they're trading, and they're just looking at the lines. They say, oh, just trade when the line does this, the line does that. And here at Top Dog Trading, we insist on actually educating you with what these indicators mean. And when you know what they mean, then when you go to trade them, you can trade intelligently and with confidence. Also helps your psychology of trading, by the way, because it gives you confidence then that, oh, I understand what this means. Let me give you a big picture point of view here. So here we see the indicator above 20. And the worst thing we could do is sell this, because the market just keeps going up and up and up and up and up. That's bullish strength. And then conversely, over here for shorts, let's look at the other direction. It stays below, well, it goes below 80, and then that's bearish strength. So what do we want to do there? We want to short. So again, both directions, it's the opposite of overbought, oversold. You actually want to trade in that direction. Now, this is a great indicator. It keeps you on the right side of the market. It keeps you on the strong side of the market. But what it doesn't do is give you a pinpoint entry. So for the pinpoint entry, you use my cycle indicator, which I give away for free to all my viewers, which you're a viewer. So go get it at indicatorwebinar.com. Again, in the spirit of Top Dog Trading, I give you the education behind the indicator so you understand it. And then this will give you entries to the penny, to the pip, to the tick, the exact entry. So go get it there. My gift to you.